Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar on managing the covered call position, you'll hear strategies about how to adapt to changing market conditions when you're managing that covered call. As always, we'll cover the material as well as your questions in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to our discussion. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the end of today's session, but our webinar today will also feature a guest speaker, so make sure to stick around for the entire hour. Please note that this questions box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And we'll be hosting a brand new addition to the OIC webinar series, a full-day session on options and ETFs, or exchange-traded funds, on Tuesday, December 1st. We have 4 sessions that will feature our in-house talent as well as speakers from iShares and ETF.com, and we'll also have representatives from 3 options exchanges. Sign up today at optionseducation.org. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, managing the covered call. Joe?
Nick, thanks a lot, and thanks to everybody for joining us today. Also like to thank Ed Modla, who, for those of you who attended the last couple webinars, did a great job. So thanks to Ed for that. As Nick said, today we're going to focus on managing covered calls. So looking forward to getting into that. Many of you who trade options know that the industry has this disclaimer, characteristics and risks of standardized options. If you're new to options, be sure to get a copy of that from either the OCC or your broker. Many of you do know who we are. The OIC is the industry cooperative funded by the OCC. As you can see on the slide, the world's largest derivatives clearing organization. We are funded by OCC as well as it's actually 12 option exchanges, 7 parent companies that are listed there. We've been funded since 1992 with the sole mission of helping investors, financial advisors, and others to understand the benefits and risks of the listed standard option. For those of you who have joined me before on these webinars, you know this is one of my favorite slides. It's the story of the growth of our industry starting in 1973. We had 16 companies in April of 73 on the Chicago Board Options Exchange. I think we traded 928 contracts that first day. And lo and behold, now we're averaging close to 17 million contracts a day. I do like to at least mention to those of you who are joining us for the first time that exponential growth really that started in 2000, 2001 period, came about really for a couple different reasons. One, the ISE was founded, which was the first electronic exchange that gave investors the ability to access the markets in a far more efficient way, rather than calling their broker calling the floor, having a ticket run out to the floor, and that whole process reversed before you got report. That electronic access really improved efficiencies. Also, in 2000, the various exchanges dual listed each option, each company that had options listed on it. So if you wanted to trade, say Google back then, prior to 99, you could only trade that on one exchange. And actually Google didn't have options in 99, but let's say IBM. You had to go to the SIBO for IBM listed options. After 99, you could go to any of the exchanges. So you had electronic access, you had dual listing, which narrowed the bid-offer spreads significantly because of the additional competition between the exchanges. And then you had improvements in technology. So all of those things, I think, spurred tremendous growth in the industry. And then we have found that since the 08-09 financial crisis, lots of investors have decided to at least take the time to join, groups like us, the OIC, in some of the educational initiatives to find out whether the listed option product is for them or not. And as you can see by the slide, lots of you are indeed using the listed options product. So we're going to kind of build on to a point and really, repeat a little bit some of what Ed covered back in late October regarding covered calls. I mean, covered calls are, one way for investors to generate additional income. So in the presentation today, we will talk about, exactly what the covered call is, as well as the risks associated with that particular strategy. We'll get into some examples. We'll talk about planning. And then, as Nick said, we'll have somebody join us to talk about some questions and some misconceptions that are out there with the whole covered call product. What is a covered call? For those of you just getting started, a covered call is where we own, for every 100 shares of stock we own, we turn around and sell a call option. Because, again, for those of you new to the space, each option contract corresponds to 100 shares of the underlying. So a covered call is when we buy 100 shares of the underlying and sell a call for each 100 shares that we own. Another terminology can be the covered rate, the buy rate. And if you happen to do this when you already own the stock, the terminology is an over rate, but it's all the same thing. It is owning 100 shares of stock, and for each 100 shares of stock, you sell the call. Is there risk? I can't tell you how many presentations I give and ask investors, are there any risk in covered calls? And, the heads go back and forth. No. Well, in fact, for those of you who are in the space, rather than just beginning, darn well there's plenty of risk in a covered call. I mean, there's risk in all our investments. But the important thing, whether it's any option strategy, is to understand, what are the risks? Are they quantifiable, or are they unlimited? Certainly, with the covered call, they are quantifiable, although significant. So the risk of the covered call is the long stock position, and we'll get into that through some of the examples as we move forward. The upside profit potential is limited, and just like the graph on the right suggests, that solid black line goes horizontal, and it goes horizontal because that represents the strike price, where you as an investor have taken in a credit, taken in some cash, the value of that call, knowing full well that you have the obligation to sell stock at that strike at expiration if required to do so. So why do we write covered calls? As I mentioned, it is all about increasing returns. Basically, we own the long stock, and we take in cash depending on what option we sell. It may be a little bit of cash, maybe a lot of cash. If we're talking the whole covered call strategy, it's important to understand that if you're real bearish on an underlying, covered call strategy is not the one for you. The forecast that makes the most sense around covered calls is an opinion on the underlying, and by underlying, just so we're clear, that means either the stock, index, or ETF that we're selling the option on, should be neutral to maybe a little bit bullish. And if you're very bullish and you're going to do this, then you're going to sell an option that's further out of the money. And we'll talk about that also a little bit later. The call premium is a potential benefit, and again, through the examples, we'll get into how that call premium really does benefit our downside. So what are the call writer's obligations? I mentioned real briefly that we sell a call at a particular strike, and as a seller of that call, we take in cash, and for that cash, we take on the obligation to potentially sell the underlying shares. And I say potentially because depending on whether that stock is in the money at expiration, if the stock is in the money, then we'll, of course, have to deliver on our obligation of selling those shares at the strike price. And that's basically the obligation of having to, when you get assigned, having deliver those shares of stock. It is possible when we talk about assignment, and maybe I'll back up just a little bit. Option buyers, they have the right, to buy the underlying when we're talking a call. Option sellers have potentially the obligation to sell the underlying. So we know in the covered call strategy, we're long stock, we're short calls, so we're only talking about that potential obligation of delivering the short shares at the strike price. Now, the vast majority of, I think it's a little over 4,200 underlyings that are traded on the exchanges now. That's a combination of stock, indexes, and ETFs, a little over 4,200. The vast majority of them are American-style options, which means you can be assigned. You can have to deliver on your obligation at any time, from the time you sold the option until expiration. But when we think about this as a practical matter, I really believe that the vast majority of the time, you can really anticipate when you're going to be assigned. And it's really, pretty straightforward. You're going to be assigned when there's no premium left in the option. So that way the owner of the option isn't giving up premium by exercising, and the other gets into a dividend. If the premium in the option is greater than the amount of the dividend, then you can expect assignment. So they're really, the two times when you can expect to be assigned. So occasionally it happens by surprise, but really, that's an exception. So again, in return for the obligation of selling the stock at the strike, the seller takes in option premium. So why is the call covered? Well, the short call is covered because we own the 100 shares of stock. That's not to say it's delta neutral. And in upcoming webinars, I know we'll get into some of the whole ideas of delta. We're not going to do that today, but we are covered because each 100 shares corresponds to one option. But for those of you who are familiar with the whole idea of delta, deltas vary between 0 and 100. So unless it's 100 delta, net, we're going to be long in that call position, especially if we're talking about an at or an out of the money call where the deltas tend to be 50 or less. Now, the last bullet on the slide is really important. Remember, upside loss potential for an uncovered call is unlimited. And that's absolutely true, and more importantly, critical that you understand. Short option positions, and there are plenty of investors who use them, have unlimited loss potential, and so you really need to be aware of that. Profit and loss at expiration, again, the upside profit potential is limited because we have sold a strike price, and in terms of our break even, it's going to be that strike price minus the stock price paid plus the premium received is, where we figure out our break even, and if we're assigned, it's going to be the strike price plus the premium taken in that will get us to our actual, price point for the sale of the underlying. To the downside, the break-even point, very simple with the covered call. And, the covered call from trying to understand where my break-even point is and where my maximum profit is, it really is, straightforward, and we'll go through a couple examples. But the break-even point is simply the price you pay for the stock minus the premium you take in for the call, and that's your break-even point. So, if you sell a $2 call, you get $2 of downside. You sell a $10 call, you've got $10 of downside. As we said right from the outset, there can be substantial risk, and the risk in the position is the long stock. In the money versus out of the money calls. A little bit of a step back just in terms of one of the core concepts or fundamentals about options. When we write in the money covered calls, in the money would mean that there is some intrinsic value. The thought is they're a little more conservative because, in the monies are going to have more value than the at or out of the monies. So you take in more premium. You may have less upside profit potential. That can vary a little bit, but you do have more downside protection because in the monies always cost more than at or out of the money calls. And so, the flip side is the out of the monies, tend to be a little bit more aggressive, less conservative because you're taking in less cash and, of course, then have less downside protection. I think the opinion or your forecast on the underlying is critically important as to trying to decide whether to sell an in the money, an at the money, or an out of the money call. Intrinsic versus time value, and of course that's what we're talking about with in the money. In the money means intrinsic value. So many options are in the money. Certainly not all of them. So those options that are in the money have intrinsic value, and most likely they have some time value. I mean, if expiration's in the next day or two, maybe there's no time value. If they're deep enough in the money, possibly there's not a lot of time value either. But the intrinsic in the money options certainly have that in the money amount plus any potential time value. The at the money options and the out of the money options have no intrinsic value, as the name suggests. They are either at or out of the money. So the entire value of those options is based on the value of time and how much that underlying moves or is expected to move going forward. And of course, I think many or all of us do realize that at expiration, there is no time value, and the option only has value if it is, in fact, in the money. So in the money calls and puts, have the intrinsic value. As I said, they may have time value. The at the money calls and puts, no intrinsic value. That's the same with the out of the money calls and puts. And of course, the at the monies have more value than the out of the monies. Little example, good old OIC's XYZ, trading at $160 a share. We got the 150 calls trading for $12. So if we've got the stock at 160 and we're talking the 150 call, hopefully, boom, right out of the box, you understand that call's $10 in the money. So we've got $10 of intrinsic value, but the option's trading for $12, so we've got $2 a time premium. And, that's what, hopefully, as you get into the covered calls, you're able to, figure out what's in the money, at the money, and out of the money real quick, have an understanding for how much intrinsic value, if there is any, and then decide, what option you want to sell. The XYZ 160 stock price with the 170 call, trading for 175. That call is out of the money by $10, but clearly it's got value, and that value is $175 in the marketplace. So no intrinsic value and $1.75 of time value. So the key in this slide, is the stock price. You can't determine whether calls or puts are in or out of the money unless you know the stock price. And, remember, stock, index, or ETF prices, that's what drives the value of options, that underlying price along with some of the other pricing components, but that underlying stock price is really important. So in our example here, we've got a stock price of $160. Clearly, the 160 calls are at the money. Those 165.70 and any calls higher than that are going to be out of the money because the stock price is below the strike price. And then any strike below the 160, in our example, the 55s and 50s, they're in the money, but anything below 160 is going to have some intrinsic value along with probably some time value, and of course then they are in the money calls. So a quick quiz. Let's left side. Let's take a look at the stock price. We got the $55 stock and a 60 call. Is that call in, at, or out of the money? Hopefully you said out and out of the money by $5. $77 stock price with a $75 call. In the money by 2. I hope that makes sense. $63 call with a $63 stock with a $65 call. In or out of the money? Out of the money by 2. $51 stock with a 50 call is going to be in the money by $1. Again, that 50 call represents the right to buy stock at 50. If you can buy the stock at 50 and it's trading for 51, the value of that call is $1 plus whatever time value. And lastly, the stock price at $22.55 with the call at $22.50 is going to be in the money by a nickel. And just as an aside, if we're at expiration and that stock, whether it's, let's say, the call strike is $22.50. If that stock closes at $22.51 or higher, so a penny in the money or higher for a call or a put, you will be automatically exercised, by your brokerage firm unless you let them know that you do not want to exercise. So that's an important detail to be aware of. So I hope you did all right with those quizzes. Let's go with a little example here. We got 100 shares of XYZ trading at $42. Again, when we talk covered calls, ideally we're neutral to a little bit bullish over the period we want to sell calls. Obviously, the motivation is to generate income in what we hope is a stable market. We do have a target price for the stock, so the stock is 42. We think it's got a shot to go to 45 over the next 90 days. So we sell one 90-day XYZ 45 call for 175 with the stock at 42. So let's take a look at how it looks. There's a stock at expiration of 42. If the stock at expiration is still 42, that's break even, no profit, no loss. We sold the call for 175. So our net profit on this trade minus commissions will be the $175. And that's the whole idea between, with these covered calls. In a stable or slightly bullish market, the ability to generate additional income. Some people like to call it an extra dividend, a free dividend, but that's, a perfect example there at $42 with the stock unchanged. Now, the right-hand column, look at how those numbers grow significantly, and it speaks to one of our very first slides. Is there risk in a covered call? Yes, there's risk. Where's the risk? It's in long stock. So if we look at the stock at expiration, back to the left-hand column, at $40, okay, we're down $2 in the stock, but we've made $175 in the call. So at $40, we're only down $25 because of the premium we took in by selling the call, less commission. But as we drop significantly in the price of that stock, 35 and 30, you can see for each, point drop in the stock, we're losing an additional $100. So 525 or 1,025 with the stock down at 30. Clearly, if we thought the stock was going to 30, the covered call position, it would have helped us. It would have saved us $175 less commissions, but clearly there could have been a far better way to protect that underlying. Then to the upside. Now, again, go back to the right-hand column. You can see whether the stock is 45 or 50, we're going to make the same amount of profit. And why is that? It's because we sold the strike. The strike we sold was 45, and therefore we have an obligation above 45 to deliver on that stock. So our maximum profit, no matter how high the stock goes, is $475. So to the downside, as we mentioned, we get that stock price. And it's important to be clear, and this is where it can be a little bit confusing. With the covered call, to figure out your break even, you take the stock price, not the strike. Okay, so you take your $42 stock price minus the $175 we take in. That's what gets us our $40.25 break even point. Now, in terms of our maximum profit, to get to that $475, how do we do that? Well, it's the difference between the stock price that we're long at 42 and the strike at 45. So that's $300 plus the 175 we took in by selling the 45 call. So in essence, we're long the stock at 42, and our goal is to sell the stock as high as 46.75 would be the strike. 45 plus the 175 gets us to the 46.75. Another example, what do we have here? August 2nd, all right? Again, we're in the XYZ. The stock's trading at 53.50. You can see the range for the year. And I think, that whole idea of range for the year is something that I like to look at as well. It just gives you a perspective for how much that stock moves. You can complement that certainly with our implied volatility charts that can be found at optionseducation.org at our website under the drop-down bar. It's about 5 or 6 over on the home page. Drop down there, look for those HV and IV charts, the implied volatility charts, to give you a sense for the level of premiums as well. So that combination of the range over the course of the last year, and I think coupled with those IV charts, can be a good way to get a sense for, whether your options are maybe midpoint price, high or low, compared to the last year. But in our example here, again, our forecast, we expect the stock to be darn stable, to trade between 50 and 55 over the next 80 days. So we decided to buy 100 shares at the current price at 53.50 and sell the OC 55 call for $2.30. And October expiration is 78 days, as the slide suggests. So stock's currently 53.50. We're long the stock. We sell the OC 55 call for $2.30. One additional important ingredient here is that October expiration we know is in 80 days, and there's a dividend of 18 cents in 27 days. So if we are long the stock, do we get the dividend? Yes, we do get to collect the dividend unless we get exercised first. So let's, without any additional slides, let's talk through this whole idea of getting exercised or being assigned for a dividend. So we've got 80 days, but we get a dividend in 27 days. The value of that call for the next 80 days is $2.30. So the only way that an option buyer should exercise that call to get the dividend is if the dividend is greater than the premium in the options. Well, there's no way with, what's that going to be, 53 days, 80 minus the 27, with 53 days, that the premium in that option is going to be below 17 cents. There's no way. The option's trading for $2.30. So we can be darn confident that we're going to, in addition to collecting the $2.30, take in that 18-cent dividend as well. And again, if you have questions about that, it's always good to check with your broker just to be sure. But our example here, we're long, 100 shares of XYZ at 53.50. We're selling this out of the money call, out of the money by $1.50 for 230. And you can see the two lines. The dotted line represents the stock. So if stock goes up, you make money. Goes down, you lose money. That's pretty straightforward. The solid black line, again, goes horizontal. That's going horizontal at the strike price, at the 45 strike. And then the reason that black line is lower than the dotted line is because, we've got $2.30 of downside protection. So our maximum profit can be up to $380, and our break even at expiration is going to be down to, 51.20. Next slide, we have the just really the breakdown at 53.50. Same situation as the prior example. We're not going to make or lose any money in the stock. We're going to take in that $2.30 from the short option, and therefore we'll make an additional $2.30. To the downside, let's see, just trying to get this. Got to work a little bit to the downside. Again, that's where the risk is. So, the further the stock drops, we know that below our break-even point at 51.20, we are just flat out long stock. So, as long as you know that, that's where you get into, and we'll talk about this, a little bit going forward, the whole idea of planning. Do you roll? Do you get out? What's your strategy? And then to the upside, just like, in our other example, and as is the case with all covered calls, you have maximum upside potential because you've taken on the obligation to sell the stock at the strike price plus whatever premium you took in. So I just want to run through the return calculations real quick, just because I think they get us as investors thinking about the price. The return isn't so important in my mind. I mean, it is ultimately, but just understanding where the income comes from, what we divide it by the stock price, and then, what that return can be. So on the income side, and this is for static return. By static, we mean the stock doesn't move, doesn't go up, doesn't go down. So in our example here was 53.50, so a static return. We know we've taken in $2.30 with the sale of the option. We're going to collect that 18-cent dividend. The total income is going to be $2.48. We got to divide that income by the price of the stock at 53.50, and that's going to give us a return of about 4.6%. If we're able to do that, we did that 80 days out, so 80 divided by the 365 suggests you could do that over 4 times a year. Now, those of you in the option space, you realize the premiums expand and contract in many of the different options that are out there. So it's unlikely you'd be able to do it at the same price over and over. Sometimes that return might be higher, sometimes lower. But just theoretically, if we were able to do it the 4.5 times, this particular strategy would net us a 21% annualized return. That was static. This is if called. So if called, well, what does if called mean? Well, it means we're getting assigned if we're called away and forced to deliver on our obligation. So how does that change our return? We've got the same $2.30 that we took in for the sale of the option to take on that obligation to sell the stock at 35 or at 45. We've got the dividend of 18 cents. Now, the difference here, we add another $1.50 if called. So the only way we're going to get called is if the stock goes through the strike at $55. So that takes us from 53.5 to 55. We add another $1.50 of premium to the income equation. So now we're up to almost $4. Divide that by the price of the stock. Again, that's a little over 7%. We do that 4.5 times, and voila, we're up to 33%. So the important thing is you've got static return and then if called. And if called is going to be the difference between the price of the stock and the strike you've sold. Again, piggybacking and getting into this whole idea of what call do we sell? Something in the money, at the money, or out of the money, depending on which strike you choose, obviously can significantly impact your returns. So typically, whether we're at the monies, at or out of the monies, the closer the money is to being at the money yields a somewhat higher static return and a lower if called return, where if we're writing an out of the money, typically we're going to yield a lower static return, but a considerably higher if called, because the out of the money leaves far more room for income to be generated in the price of the stock to that strike. So, honestly, this is where some of the fun comes in, I think, trying to figure out, which stocks work for you. Hopefully they're stocks that you're comfortable with, and then getting a sense for where the level of option premiums are. And then, if you believe in the strategy, just doing it repeatedly, consistently, with a lot of discipline. Planning and considering potential what-ifs, obviously we want to start with a plan, and I kind of referenced that in terms of, well, obviously we need cash to do this, but finding the stock, and you want to typically do these positions with stocks that you feel neutral or bullish about, and then, the challenge can be, what's the best strike, what month to sell? Do you want that in the money, at the money, or out of the money? So, again, with regards to planning, it's important that you set that plan at the outset. Don't just put something on and then, forget about it or hope. Have a plan. Are you willing to sell that stock at the strike? If you're not, then you have to manage that position as we get to the strike or through the strike. Either close it out or roll, and that's something that you need to be proactive about. It's proactive is good. It's not that it's necessarily a hard thing. It just really takes discipline. Having a stop-loss point, for those of you who may not know what that means, again, there is risk in a covered call position. The risk is the downside. So if you're not going to put on that covered call, as I suggested earlier, in an underlying where you think it's going to head down appreciably. So if it starts to go down appreciably far more than you ever anticipated, it's a good idea in advance to say, hey, if something changes and the stock gets to a certain point, maybe I'm just going to take my loss. Although your loss, of course, would be less than if you just owned the stock outright by whatever premium you took in for the call. You might have a stop-loss point where you just close the thing down, you sell the stock, and importantly, buy back that call. You don't want to just leave a short call and then, either move on to a different strike or to another stock entirely. Always a good idea to diversify through different sectors. Always just, that's a fundamental investment idea. And again, getting to the idea of whether you're writing in the money, at the money, or out of the money calls, I think just investors tend to get comfortable in certain rhythms and certain disciplines, and that really comes up to you. So, that's a couple things with regards to covered calls. I think there are lots of misconceptions and questions, and I think with that, I'd like to bring in our guest, Ed Modla. And Ed, you out there today?
Yeah, thanks for having me here today, Joe. It's good to be here.
Hey, thanks for joining us. And for those of you who've been on the last couple webinars, Ed's done a great job with them. Ed's part of our OIC Investor Services team and does a great job there as well. How about if I know we got a couple questions here. I know Nick's suggesting that there may be some other questions coming in from our listeners as well. So how about if we start with how do you go about choosing stocks for the covered call positions?
Yeah, it's a good question. Of course, this is very important because you have to have the right opinion of the stock to fit the options trade to it. And there's a number of different ways you can choose stocks. I talk to investors who subscribe to services or get advice from different sources. But if you're doing things on your own, for the most part, it comes down to a combination of fundamental and technical analysis. I like to use both myself, but I do talk to investors that lean fully on one side or the other, and they're committed and comfortable with that. But for myself, the way I like to do things is to start with a fundamental analysis of an underlying and look at some numbers to determine a valuation on a stock. And of course, with the covered call, what we're looking at here is a neutral to bullish or slightly bullish opinion. And if it looks like the fundamentals are fitting that narrative, then we can drill a little deeper and I'll look at the technicals. And of course, by technicals, I'm talking about a chart study, a chart analysis, and that can help you really fine-tune your entry and exit points. So if you put all that together, for example, and you can define a support and a resistance level in a certain underlying that happens to be trading at or near support level, that can be a definition of your entry point on the stock, and the resistance level that you've identified can identify a strike price for you. So that analysis has then constructed your trade for you. You would buy shares as it's trading near its support level and sell a call option at a strike price near its resistance level. So that's the way I like to do it. Of course, there's many other ways, but putting together that deep analysis and letting your market bias and market direction dictate the option spread seems to be a sound way to do things.
Ed, I like that a lot. I agree with you wholeheartedly. I tend to, look to the technicals more so than the fundamentals myself personally, and that comes from my background of trading on the floor for a long time, being a charty, and really believing that stock charts are the fundamental universal supply and demand opinion of an underlying. So let me ask you this: if your resistance point is way out of the money, so you couldn't take in a whole lot of premium with that strike, would you consider doing a strike that's maybe a little closer than that resistance point, or does it depend on the investor?
Absolutely right. The level of premium that you would receive certainly is going to dictate whether or not the spread is worthwhile. We know that the idea behind the covered call is to bring in some extra premium, but we know we're giving up something, and that is profit potential to the upside. So the question can be out there, which is the amount of premium I'm receiving here worth it? Should I sell this call and take on this obligation? And it certainly may not be. If it's far enough out of the money, the premium may be too low for you to take in the risk of having to get rid of your stock should a move higher occur. So a couple of things. You said one thing that came to mind, which is you could sell a lower strike, certainly. You could also look to hold a stock position and enter the covered call in what we defined earlier as the overwrite own stock, and if you get a rally closer to your resistance level, maybe premium gets into that option and makes it worth your while to sell. But as this is going along, if your resistance level is far away from your entry point, it's very possible that your resistance level won't be breached for quite some time. And if your resistance level is far out of the money, but you don't think it'll get there for another month, then what you said, Joe, is absolutely right. You could sell a lower strike and bring in some significant premium that's a little bit closer than a month in. So maybe go a week or two out and look to sell a call there. And if your analysis is correct, that call may expire worthless, and you'll be able to sell another call after that one expires.
Very good. Do you, when you're talking to investors, get a sense for whether investors prefer to sell in the money, at the money, or out of the monies?
We get the question a lot, and I think when it comes to investors who are considering this strategy, it's something they wrestle over quite a bit. But what we tend to have the discussion about is what level of premium are you trying to obtain here? It's the extrinsic value, and depending on your opinion of the underlying, how aggressively bullish do you want to be, you can then determine whether or not in, at, or out of the money is most appropriate. So in my opinion, you may make a different decision from one trade to the next. The out of the money option is a more aggressive trade. You have a higher break-even point, but you're giving yourself the opportunity to make money should the stock run up higher to the strike price. With the at the money or the in the money, there's more premium to receive there, lower break-even points, but you can't capitalize on that move higher. So I don't think there's a cut and dry answer. We get people that come at that question from all angles, but I think from my perspective, your opinion on the underlying and how aggressive you want to be to the upside will dictate which strike price you want to sell.
Makes sense. And how about, and this is true whether it's covered call or any investment, what's the worst case scenario with the covered call position?
Yeah, well, you pointed this out earlier when you looked at the chart of this position, and when I see worst case, I always just think where your greatest loss is. And what people need to understand is even though this is considered a conservative strategy, the downside has a loss profile that is very similar to just being long stock. And you pointed that out, Joe, earlier in the presentation when you had side-by-side charts up of the covered call versus long stock. The covered call lowers your break-even point. That's true. It's a conservative spread. That's also true. But as the stock continues to move lower, once you break through that break-even point, there is no protection there. So your worst-case scenario that you have to be familiar with and aware of is a sharp move lower, and how do you handle that if it happens?
And that is the question. How do you handle it? Which actually that kind of rolls into the next question. And then, of course, if the stock is heading south during the trading day, that's one thing. If corporate news comes out and it's completely unexpected and you get a gap, there's nothing you can do. But rolling into this next question, assuming the stock is trading over the course of the day and heading south beyond what maybe if you had the discipline to figure out a break even, or not a break even point, but a stop loss position, do you think it's better to do just a close out and move on, or roll down to a lower strike?
Well, in general, when things are going wrong, in this case, when things are going bad, it's never a bad idea to close out and move on. But in this case, I would say it depends on what your definition of bad is. When you enter a position, especially one like this that could have significant loss attached to it, it's always wise to know how much loss you can tolerate. And if you reach that level, never a bad idea to take your loss, move on to the next trade. But if you haven't reached that level and you may just have a small loss or a move against you that you weren't expecting in a more muted way, take an honest reevaluation of what your opinion is on the underlying. And it's certainly possible that you may think that the stock really has bottomed out where it is, and then rolling down your strike, or meaning buying back the call that you're short and rolling down to a strike so you can receive more premium, is a viable way to manage the position. But again, that would be something more advised to consider if you haven't reached that point where you've reached the maximum amount of loss that you could possibly tolerate in your position. So be careful of that.
And I agree with you. And you said a couple things that were real important. The whole idea, if you're going to roll down, you got to be sure to cover that existing short call and then roll down. You don't want to be in a situation where you're short 2 calls and long 100 shares of stock, and be in a situation where you have far more risk and then also required capital commitment for a position like that. So, yeah, it makes a lot of sense. Let's talk expiration a little bit. So,
okay.
How do you think managing around expiration makes sense? Do you hear from different investors how they like to approach it?
Yeah, I do, and it's a good question. Whether it's the covered call or really any other option spread that investors have, what you do at expiration, and what I always tell people is to think about what position you want to have after expiration, and then make sure you manage it appropriately going into that. So with the covered call, there's some different situations you might be in. Of course, we could add more detail here, whether or not the call is in the money or out of the money. What do you do under different circumstances? Do you let yourself be assigned? Do you buy back the call? Or if it's an out of the money option, do you close the entire position out or sell another call? There's different things you can do, but ultimately, you want to have and reestablish the position that you want to have come the day after expiration. So you have to be mindful of that and not just stick to the opinion and market outlook or bias that you had when you entered the position, but reevaluate that. Whatever methodology it is, fundamental or technical analysis, or whatever other views or opinions you're incorporating to your market outlook, view that again, put it together, and put together the position that you want to have after expiration, and make sure you manage it as that call expires.
let's talk about that again, and just with the idea that here we are, we're at expiration. It's Friday afternoon, and the stock's trading right at the strike. Okay.
Mm-hmm.
Say that. What are the choices? Let's make it clear to our listeners exactly what the choices are right there at expiration, and how do you make a decision on those choices?
Well, if you're right at the money, one thing, of course, you don't know for sure is whether or not you're going to be assigned there. If you don't do anything, do I have stock come Monday morning or do I not? If that's a risk you're willing to take, then you can go ahead and let your call expire, own shares come Monday morning, and then redecide from there if you want to sell another call or not. But if that call, which is at the money, has been reduced all the way down to zero and it's lost all of its time value, which you likely would have profited from, then another choice you would have would be to close out the entire position. That would mean selling your shares, buying back the call that you're short for a penny or two or whatever it is you'd have to pay to buy it back, and eliminating that risk, closing the position, capturing the profits, and then having no exposure come Monday morning, no long stock position or nothing. So it depends on what your risk tolerance is and what position you want to have on Monday, but there's a few things you could do if your call was right at the money at expiration time.
That's good, and I think you did a good job explaining it the first time, but because I think it's so important, I appreciate you going through that, in a couple choices a couple times for our listeners. We got a couple misconceptions out there. How about if we go through a couple? The larger the premium, the better. Well, first of all, what does that mean?
Yeah, we hear this a lot. Investors will call us up and they'll be interested in covered calls of a certain stock because they see large premium amounts. And when they do their return calculations like you did earlier, Joe, looking at what they could potentially make, it looks like a huge amount of return, and their eyes light up and they want to make that trade. And we have to caution people on that. Of course, there's nothing wrong with trying to earn a great return on your money. That's what we all are here for and want to do. But you have to be mindful that the market is efficient, as it says here on the slide, and larger premium could very well attach itself to larger risk. So, inevitably, at some point in time, you will see a huge amount of premium for an option where you can put on a covered call and earn a great amount of return and feel like it's fairly safe, but you have to be aware that maybe there's an announcement coming out. Maybe you didn't catch that an earnings is being scheduled a few days before that option expires, and that's why there's so much premium, because of the perceived possibility of a large move or higher volatility in that stock before the option expires. So generally speaking, a larger premium could attach itself to larger uncertainty about a stock move, and there's risk there. So the larger premium could be better. That might not throw you off. Maybe you're still bullish and you want to make that trade, but be cautious, and sometimes the lower premium may attach itself with such lower risk that that's the better trade for you. So it's not always better. Certainly you can consider it, and you might lean that way, but you have to be mindful of the possibility for big moves against you.
So know your risk tolerance as an investor, whether it's covered calls or anything else. And also, when it comes to covered calls, don't chase yield. Work in those stocks that you're comfortable with. Agreed?
Yep. Make sure you do your due diligence. You can check the yields, but also evaluate your risk and what might be coming up, and be mindful of a possible down move. And if that possibility is greater in the covered call trade that has the higher possible return, that might not be the trade for you.
And you can also check those yields and returns at our website, optionseducation.org. You can use the calculators on the website.
Yeah, we actually have a covered call calculator on the website under our tools and resources section.
Perfect. Yeah. So, don't be afraid to use those tools that are out there. And of course, all of them are paid for by the industry, so no charge for any of that. Another misconception, being assigned is bad. It can be good or bad. So, speak about that a little bit.
Yeah, so this comes down to what your objective was when you entered the trade initially. In fact, there are plenty of investors whose intention is to be assigned. When they enter the covered call, they want to capture some upside move and increase their income with the option premium, and there might not be a long-term investor in the stock, so they're perfectly comfortable with being assigned, taking the profit that they captured and moving on to another trade, possibly another covered call trade. So in those cases, investors are perfectly happy being assigned. It's a profitable trade and they can move on. So I think the misconception comes in because people think that if they are assigned, they have to give up something that they owned that they wanted. And when you enter the covered call, that doesn't really, that's not consistent with what the covered call mindset is. You know you have the obligation to sell shares at the strike price. If you're willing to do that, then being assigned would not necessarily be a bad thing at all. In fact, if your objective was to capture that upside move and capture the premium on top of it, it can be considered a good thing.
And that calculation would be if called, when you're assigned. So you're going to reap the benefit of the stock price getting to that strike price plus the premium. Another misconception is this whole idea covered writing is good because most options expire out of the money or worthless. What about that?
Yeah, this is a very widespread opinion. I think a lot of sources tend to say this. I'm not sure exactly where it comes from, but it really isn't true. And this misconception is saying that people think covered call writing is good because it includes selling an option. And since so many options expire worthless, that it's a good spread and it's profitable. That's not the motivation that you should have if you're going to use this spread, because you can see here, in fact, it's just not true. Most options are actually closed out in the options market with a closing transaction. So for anyone that buys an option, they're selling it back to the options market before it expires to close it or vice versa. That's the way most options are exited, not through expiring worthless. Some go through the exercise and assignment, and of course, some options are held through expiration and expire worthless, but the majority of them are traded out of. So it's just not true. Your motivation for the covered call is not that. Instead, it's the things you talked about, Joe. You have a neutral or consolidating market environment, or you're slightly bullish and you want to capture on that move. Those are your motivations for putting together this trade, generate a little more income, possibly have a little bit of upside on the stock, and lower your break-even point on the downside. You talked about that as well, the dual benefit of having additional income and lowering your break-even. Those are your motivations for wanting to do the covered call, not because options are expiring worthless all the time.
Good explanation. I think we got one more, and that is covered calls force us to sell winners and keep losers. The whole idea of investing requires active management. Declining stocks should be sold. If the short call is assigned, you can repurchase the stock if you're bullish. What about this whole idea of selling winners and keeping losers?
Yeah, I think this misconception comes from investors who really don't manage their portfolios very well. And we do hear this from time to time. I think that partly might be because of a lack of understanding, or as you pointed out earlier, what we just talked about a few slides ago, Joe, is what are your choices? Some investors don't know what their choices are and what they should do when their option trade moves against them, or even if it moves in their favor. What are their choices and what can they do? If you actively manage the position, meaning you're disciplined, and you get out of trades when you're supposed to if they move against you, or you adjust them by rolling the position or even buying back a call. If your opinion has changed and you're aggressively bullish on the underlying, you can buy back the call and continue to hold the stock for a move higher. If you're doing these things, then there's a pretty good chance you're going to fall off of this category of investors who are getting rid of their good stock positions and keeping the losers. If you don't do anything and you just sit on your positions, then the best performing stocks very well could get called away from you, and the worst performing stocks would sit in your account if you did nothing. And I think that's where the misconception comes from. People who don't manage and actively participate in their portfolios. And generally options traders are more active and more savvy, and the people we talk to are very actively managing their positions. So, if you start this way in the options world, you generally don't stay here very long, because as you get involved with options, you know how to manage your positions and you become much more diligent and responsible with your portfolio. So I think this is a misconception that's real, but for options traders, it's a little bit less. And for those new to options, they tend to become a little bit better at managing positions over time, and this misconception eventually goes away.
Good explanation. I hope that makes sense to our listeners. So just to really wrap it up, and then we'll get Nick on here. Maybe he can fit in one question because I think we're running out of time. But, the whole idea of the covered call strategy, as we've said over and over, both Ed and I, It is appropriate for neutral to moderately bullish stock outlooks. We're looking obviously to increase income in what we hope is a stable or slightly bullish market. Profits are limited because we take on an obligation when we sell that strike. That's our obligations, and losses can be significant if the stock falls below our break-even point. So, Nick, I'm sure you're still out there. Do we have time for a question or two?
We are at our 60-minute end time, but I think we can get one question in there. Joe and Ed, we did have a number of attendees ask a similar question to this, so I think it'd be worthwhile for us to hit on this, and you both can take a crack at it. Ed, why don't you go ahead and start one? This particular investor, or these investors in general, have heard that selling puts is actually the same as doing a covered call. Is that the truth? And can you tell us a little bit more about that?
Yeah, that's a really good question, and that sounds like a savvy investor out there. Very similar. If you put up the P&L graph of the covered call versus the naked put or selling a put, they would look identical. Of course, I want to put this in perspective. We're talking about a comparison of a buy right, or buying the shares and selling the call, versus selling a put at the same strike. So your covered call and your short put would have the same exact strike attached to it. And yeah, there's some differences here. Of course, one spread has two legs, a long stock and a short call side, and the other spread just has one. That would be just the short put side. But from a risk perspective and a risk profile, you'll see these two spreads are very similar, if not exactly the same. Now, there might be some monetary differences in the cash requirement or margin requirements with these two positions, but very good observation. The strategies page on our website at optionseducation.org is a good place to go to read through both of these strategies and compare that P&L graph side by side. You can see how similar it is. What do you think about that, Joe?
No, I think that's exactly right. And as you said, Ed, and Nick, you picked out a really good question, because that risk profile is exactly the same. And so, again, oftentimes investors aren't quite clear about some of these risks and benefits, but the covered call and selling the put or selling the cash secured put do have exactly the same downside risks. As Ed said, there may be a little difference in terms of the capital required for the various positions, but they're similar. They are income generation strategies. And again, as Ed pointed out, be a good idea to check out the website for any further details. But good stuff, Nick.
Joe, let me kick one other question over to you as our last one from the audience today. Is it better to roll down on a covered call that's gone bad, or is it better to just close it out?
Wow, another good question. Is it better to roll or close it out? And I'll go back to, you as the investor need to have the plan in place before you put on that position. So whatever the plan is, Ed spoke to it a number of times. What's your risk tolerance? Your risk tolerance is, I think, going to decide whether you want to roll down and fight, for a profit out of this position if, in fact, you're wrong. Because the fact is, if you're rolling down, your forecast on the underlying was wrong. So my preference, frankly, is to cut and run. And the real reason there is more about the mental aspect of investing as opposed to the monetary. None of us like to lose, but when we cut that loss, or when we cut the potential loss, of course it's painful right away, but the ability to have a clear mind, not suffer with a position that's going bad that you have to put a lot of time and energy into to just maybe try to break even or get a small profit out of in the days or weeks or months ahead, it typically isn't worth it. So, cut the position, roll on to the next thing, have a free mind that allows you to find that next opportunity instead of sometimes being paralyzed with a position going bad. Ed, anything to add on that?
No, he's had it exactly right, and it was something I touched on earlier. It's never a bad idea to take your losses and refresh your mind, refresh your analysis of the market, and put together a new trade. When something has gone wrong, it's often the hardest trade to make, to take that losing trade and move on. People tend to try and hold on to trades and hope they come back. But if you ever find yourself hoping that things are going to turn around for you, and then that's when you might be getting yourself into trouble. So when you have to cut your losses, start over, and get into a new trade that might work out better for you, that's always a good idea.
Hey, just one last thing, Nick, and I know you'll close it up for us, but if I heard it once on the trading floor, I heard it 10,000 times. Sell hope.
It's a good idea.
All yours, Nick.
Gentlemen, thank you. Gentlemen, we have quite a few more questions to get to. I think we had a very savvy investing crowd today, but unfortunately, we are out of time to get to any more. So I do want to remind our listeners that if you have any further questions about the concepts we discussed today or any of the tools on the OIC website, or if you submitted a question and we weren't able to get to it or discuss it during that misconception section, please contact our investor services team at options@theocc.com. And of course, Ed from today's discussion is part of that investor services team, so you actually might get Ed responding to your question. They're ready to help answer questions about strategies or positions. Also, as I mentioned, today's session will be archived and accessible in a few hours using the same link you used to join us today, and our webinars are available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. Many of you asked about further education, so please visit optionseducation.org and see the Getting Started section for further reading. And of course, make sure to check out the website at optionseducation.org in the upcoming weeks. As I mentioned earlier, we'll be hosting a brand new addition to the OIC webinar series, which is a full day on options and ETFs, or exchange-traded funds, which will be held on Tuesday, December 1st. We have 4 sessions that will feature our in-house talent as well as speakers from iShares and ETF.com, and we'll also have representatives from 3 different options exchanges. Sign up today at optionseducation.org. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.